Netflix just came out with its full year 2021 results, which made the stock crash 20% after hours. We will look at the latest numbers and update my discounted cash flow valuation to assess whether Netflix is a buy today after this huge crash. Welcome back everyone to the Modern Investing channel, and let's dive into it. Netflix business model is to collect monthly membership fees from users who are then eligible to watch Netflix content or third-party movies and TV shows on the Netflix platform. So there are essentially two ways Netflix can make money: adding new users or increasing the monthly fees. Netflix customer base is a whopping 224 million users worldwide. From this last conference call, we got to know that in 2021 it grew at 8%. And as you can see, 2020 had the steepest user growth thanks to the lockdowns that incentivized people to watch more movies, and this generated a pull effect in customer acquisition, which therefore decelerated growth in 2021. So I think that the slower growth in 2021 is more of a bias of the huge growth that Netflix experienced in 2020. Let's look at the last year's key financial metrics for Netflix. Revenue grew impressively from 3.6 billion in 2012 to 29.7 billion this past year, generating a compounded annualized growth rate of 26%. Gross margins steadily got better over the years, reaching 41.6% in 2021. Gross margins is what is left from revenues after subtracting cost of producing Netflix content. To calculate the operating margins, you have to take the gross margins and include operating costs like salary for Netflix employees, HR, etc. We can see that in 2021, operating margins were 20.9%, meaning that 79.1% of the revenues were left after taking into account the cost of delivering Netflix content to customers and paying for operating expenses. We can see that operating margins increased over the years, and this is great to see. It means that the business can scale in a profitable way. Because of the increased revenues and better margins, we can also see that earnings or net income increased dramatically over the years, reaching 5.1 billion in 2021, which is a whopping 89% compounded annualized growth rate for the last 9 years. Pretty astonishing. If we move to the cash flow statement, we can see that cash flow from operations turned positive in 2020, but had a steep decline in 2021. Cash flow from operation looks at Netflix core business and asks how much money did that generate for the year. By subtracting the capital expenditures from the operating cash flow, we obtain the free cash flow, which is the cash that Netflix can use to pay down debt or fuel more growth or reward shareholders. Free cash flow is one of the most important metrics because it shows how much cash has the business actually generated. We can see that free cash flow pretty much follows the same pattern as operating cash flow, turning positive in 2020 and dropped to negative values in the past year. This is somewhat alarming because it tells us that Netflix is not yet at the position where it can reward shareholders with constant streams of cash. The number of shares outstanding increased over the years at a 1.1% pace per year. It is not great to see dilution, but this is not a steep increase in share count. Debt is a big issue with Netflix. We can see that it increased at a rapid rate over the years in order to pay for the increased content on the Netflix platform, matching the revenues growth. But this is not all with debt. Netflix has another form of debt that doesn't figure out in these numbers, and that is content obligation. As you can see, content obligations reached almost 20 billion for the last few years, and it was 23 billion in 2021. Content obligation relate to the acquisition, licensing, and production of content and is another form of debt that, due to accounting mumbo-jumbo, doesn't end up in the previous liabilities that I showed you in the table. So the actual total liabilities at the end of 2021 were around 51 billion and not 28 billion. And total current assets were only 8 billion. This is a huge amount of debt, and it is one of the weakest factors for Netflix business model. Netflix is an expensive business to operate, and by now there is way too little free cash flow to pay for it. The risks for Netflix is the huge amount of debt that we have just seen, as well as increasing competition. Disney+, Hulu, Discovery, Prime Video, etc. And a competitor like Disney already has a ton of its own content, and therefore they don't need to spend as much on content creation like Netflix does. The free cash flow yield is extremely low as compared to other companies, less than 1% for Netflix and around 10% for Discovery. On the positive side, Netflix has quite a bit of pricing power. They recently announced that they were increasing subscription fees for North America, and those customers are likely to stick around, also with the higher prices. Moreover, the average revenue per user is much lower outside of North America, offering potential for expansion. Along with that, far the majority of users are from North America, suggesting the possibility of reaching other geographical areas. Gaming is another growth vector that has been mentioning a lot around Netflix. On November 9th, 2021, Netflix started offering free games for its customers on mobile. Right now, that is included in the membership fees, but who knows whether this could be potentially an additional revenue stream for Netflix. At least it demonstrated that Netflix can become with time more than a TV platform and more as an entertainment platform. Let's now move on to the discounted cash flow valuation. To make the model, I made some assumptions on Netflix future growth. You can see here in the table we have the revenues, average number of customers paying a membership, and how much each customer pays for the membership each month. And here we have it broken down in the 4 geographies: North America, EMEA, Latin America, and Asia. In this column here, there are the latest number reported for 2021, and over here there are my predictions for the next 10 years. Let's dive into my growth expectations. I expect that in 10 years, there will be 116 million people in North America having a subscription, as compared to the 74 million today. This would mean that about 1 person out of 5 in North America will be subscribed to Netflix, and that would give a compounded annual growth rate of 5% for the next 10 years. I also assumed slight higher growth in EMEA due to the lower Netflix penetration, and I expect that it would reach 110 millions in 2031, with a 6% compounded annualized growth rate. Latin America, I expect it to grow faster at 7%, and Asia Pacific even faster at 8%, due to the very low penetration in these markets. Moreover, I expect the average revenue per user to double in the next 10 years in all geographies, and that is the yellow lines in the table, which would give a growth of 7% per year. With these numbers, I calculated the predicted revenues in green over the years, and then I calculated the predicted net income by multiplying the revenue by the net income margin. The net income margin have been steadily increasing for Netflix over the years, and they now stand at 17.2%. I assume that the net profit margins will level out at 20%. They are on an increasing trajectory, but with the high competition, I assume that they will not be able to go that much higher. After all, 20 is very high. Discovery, for example, has a net profit margin around 10%. And I think that it's fair to attach higher margin to Netflix since it is the leader in the space. But 20 is probably the limit because of the capital-intensive business model that Netflix has. This gives us a predicted net income over the years in this row, which translates in a 15% compounded annualized growth rate in net income over the next 10 years. I will use this growth rate in the discounted cash flow model. Here is the discounted cash flow model. We have the 2021 and 2020 net income over here. These are my input values. The growth rate for the next 10 years that I set at 15%, the discount rate at 10%, the terminal PE multiple after 10 years, which I set at 20. That is much lower than the 47 it has now, but in 10 years, much of its growth I expected to be exhausted. The current assets and liabilities, including the content obligations, and the 455 million shares outstanding. In this row, we have the predicted net income for the next 10 years, starting from the average net income of the last 2 years, and in the row below, the discounted values at 10% discount rate. And over here we have the terminal value, assuming a PE ratio of 20 in 2031. If we sum them up, we get an intrinsic value of 157 billion, that corrected for cash and debt, as well as divided by the 455 million shares outstanding, gives us a present fair value of the stock of $250 per share. Netflix, after the crash, is trading at $400 per share, which makes it still extremely overvalued. Even if you decrease the discount rate to 6.5, which is the weighted average cost of capital, we get a present value of $363 per share, which would imply a downside to where the stock is trading now. Apparently, other investors are expecting net income to increase higher than 15% per year, but in my opinion, this is too optimistic. In conclusion, Netflix as a business is doing amazing, keeping on acquiring users, grow revenue and net income. However, the valuation of $400+ per share is far above my calculated intrinsic value of $250 per share. I see continuing growth opportunities, especially in emerging markets, for user acquisitions and all over the world for increased average spending per user. Moreover, gaming could be an additional future growth story. Nevertheless, the business is very capital intensive, and it will have to find a way to pay for the content obligations and debts, which will be painful. I don't see me as a shareholder be rewarded in the medium term. They will not have the capital to make buybacks or distribute dividends for many years. Therefore, this is not a buy for me unless it was to make an epic crash below $250 per share. In that case, I would reconsider. That's it for today. Let me know in the comment below what you think about investing in Netflix, if you own the stock, and what are your growth trajectories. See you in the next video. Before we go, I must remind you that I'm not a financial advisor and this content is not financial advice. It's just my opinion and you should do your own due diligence before investing in any product. Have a great day.